Welcome back to Yahoo Finance Live, everyone. Amid expectations of another 50 basis point rate hike at the next Fed meeting, some investors may be concerned that if the Fed raises rates too aggressively, then it could drastically impact economic growth. Joining us now to discuss what she calls an unwinnable fight for the Fed is Amanda Agati, PNC Asset Management Group's Chief Investment Officer. From the mindset of a consumer or anybody that's been tracking the Fed activity, and we know the Fed is paying more close attention to how they are perceived, that's not something I want to hear, that it's an unwinnable fight right now.
Well, it's not really something that I want to have to talk about either, but I think at this point we have to be really realistic about what the Fed's policy tools in the toolkit can actually do, given the perfect storm of macro headwinds that this global economy is facing. You know, the Fed is very much used to tightening policy in response to an overheating economy. But I think what's interesting this time around is we're already in a slowing expansion phase of the cycle. And when you look at some of the macro headwinds that are swirling, you know, clearly Russia, Ukraine putting a ton of pressure on the commodity complex and energy prices in particular, the zero tolerance policies and lockdowns in China, which may be finally starting to loosen up a bit. But you know, just because the Fed decides to hike rates or taper its balance sheet, likely to have minimal impact on some of these macro forces. And so I do worry that there's a scenario here where the Fed just continues to hammer away at tightening policy, either because they feel like they're behind the curve or, you know, trying to fight a credibility issue. But we can only make so much progress in terms of those Fed policy tools until we start to see some of these other forces take some of the inflationary fire out of the backdrop. I don't think the Fed can solve it alone.
Yeah, I mean, and Jay Powell has been clear about that too, right? That he doesn't think the Fed can solve it alone. I mean, what you're describing, even though I know there's a lot of debate about it right now, what you're describing does sound like a pretty surefire way to go into a recession, Amanda.
Well, yes. Now, recession is not our base case. You know, it's definitely not July, and so I'm not going to talk Christmas in July necessarily, but I'm putting my wish list together for Santa, and I'd already be very much focused on a Fed pause as the single biggest catalyst to stabilize the market backdrop and certainly the economic backdrop. We don't think that they're going to pause here in the short run. We think they're going to go 50 in June, 50 in July, and then at least 2 to 3 more 25 basis point rate hikes. But what I would say, though, is that the good news is markets are already there. Financial conditions have already tightened. And so to the extent that they deviate from that path, that's where I think the market impact may start to come into the equation. But we already have that fairly clear line of sight baked in from a market perspective.
Amanda, this target warning this morning should be a major red flag. Is that a screaming sell signal on stocks?
No, actually, I'll take the contrarian view on that.
Oh, come on. People are not buying furniture.
What's that?
Nobody's buying furniture.
No, and that's because the consumer is focused on experiences and getting outside and traveling and you know, services-oriented expenditures. The consumer is in outstanding shape. Consumer balance sheets are really, really strong. So even though it feels like late innings of this cycle, and even though the cycle has been so short by you know, historical comparisons, we actually think the consumer is in great shape. It's just this pendulum swinging from focused on just purchasing lots of goods and durables to now services. We're reopening, right? We're pretty far into the reopening, even though we're kind of living with the variant here. And so I think it's more of a shift in terms of behavior than an indictment on the health of the consumer.
I mean, I would love to see some sentiment around the services spending that consumers are actually enacting, because so much of that is probably just tied up in everybody's wedding that got pushed back and now we've all got to go to this year. But even going forward from here, where would it show up in the data where consumers are actually not just in discretionary goods purchases, but even in some of their services spending, in some of that travel? If they did start to pull back concertedly in that, what type of knock-on effect would you expect there?
Well, I think what we're looking at, it's really a function of something we've been looking at even since the onset of the pandemic, but what we continue to look at in terms of gauging the health of the consumer and consumer behavior is all the high frequency data. What do open table restaurant reservations look like? What does airline passenger traffic and volumes look like on a weekly basis? There's a number of high frequency data points that for the most part have actually now returned largely to pre-pandemic levels. And so to the extent that we start to see any faltering in those really short cycle indicators, I think that might start to give us some pause. But we're still, clawing our way back, or basically back to pre-pandemic levels. We haven't seen any weakening there. And the other thing, if I zoom out and just say, all right, well, what does earnings growth look like, broader speaking, for the overall market? We haven't seen any faltering in terms of earnings growth. And so, yeah, there's some headlines out there that are pretty ugly. Yeah, there have been some, company-specific missteps, but the fundamentals actually continue to look really strong. What we've seen on a year-to-date basis is a lot of multiple compression, but we haven't seen the underlying fundamentals deteriorate. And I think that's really important in terms of how much time is left on the clock here in this cycle.
Well, we appreciate that contrarian take. As always, Amanda Agati, PNC Asset Management Chief Investment Officer. Always good to see you. We'll talk to you soon.